travel isn't just about destinations, it's about the people you meet, the cultures you immerse yourself in, the stories you carry home. I'm Relebogile Mabocha, and on my travel feature, I take you on a journey beyond the guidebook. Each week, I connect with fellow travelers, insiders, and storytellers to bring you the heart of every place, whether it's a hidden gem right here in South Africa or a dream destination abroad. Join me as we travel through conversations, memories, and inspiration. Listen wherever you get your podcasts.
The Money Show.
Personal Finance with Warren Ingram.
20 minutes now to 8, and we're going to get into our personal finance feature with Warren Ingram, the co-founder of Galileo Capital, talking to us about your personal inflation rate and why it matters. Now, most of us will keep track of CPI, looking at the prices of goods and services, but how much do you keep track of your personal inflation rate? Warren, welcome again to the Money Show, and thanks for joining us this evening.
Thanks so much, Motheo. It's good to chat to you.
When we talk about a personal inflation rate, what exactly are we talking about?
We're talking about how my cost of living changes from one year to the next, how your cost of living changes, and it is a very different number to that CPI number that we often hear about on the radio. We'll often hear the Stats SA or the Reserve Bank will say CPI. I know they put out a number recently saying that CPI has dropped to 2.7%. And I don't know about you, but when I look at my cost of living and I talk to my friends and the like, we kind of say to ourselves, well, hang on, my cost of living is not only going up by 2.7%, it feels a heck of a lot more than that.
Yeah, you're not feeling the love.
Yeah, I don't know who these magical people are whose cost of living is only going up by 2.7, but it's not me. And so I think a lot of people feel the same. And actually, I mean, to not make a joke of it, but some people even think it's kind of a conspiracy that Stats SA or the Reserve Bank or somebody's lying about the number. And so maybe just to break up the difference. So the CPI number is a national average. In other words, it's a basket of goods that the economists have decided on, and they say we're going to put certain food items into this basket of goods that are most typical for most South Africans. We're going to put the cost of fuel in there. We're going to put some form of a cost of housing, et cetera, et cetera. And then they come up with a number, and then they measure that number and how it changes from one year to the next. And we need to understand an average is a funny thing because your feet could be in the fire and your head could be in the freezer, and then the middle of your body is an average temperature. And then you might say, well, I'm not fine at all because my feet and my head are in trouble, but on average my temperature is fine. And that's the same with an average. An average can hide a lot of different things. So when we look at our personal inflation rate, what we're actually looking at is how does like my basket of goods change from one year to the next? So the food that I'm buying, is it certainly more or less expensive than what the national average was? And for a lot of people, you might find transport is a bigger portion of their costs than the national average. And so if fuel is going up quickly, then their cost of living actually might be accelerating a lot faster than someone who maybe lives, in a place where they don't travel at all. And they might find that their cost of living is accelerating more slowly. And the same if you grow your own food, or you're relatively healthy and you're not spending on healthcare, which might be accelerating. So each of us has an individual cost of living, and it's by no means meant to look exactly the same as that CPI number that we always hear about.
So apart from the national average, you're saying we should still do the homework of making sure that on a case basis in our personal lives, we know how we are affected by inflation. For instance, somebody who has a longer commute to and from work will obviously spend a lot more on fuel. So they'll be affected by any fuel increases in terms of inflation. And those that, are living off their own gardens sometimes and buying and not necessarily buying vegetables, but just picking them from their own garden would be less affected by price increases in terms of food.
Exactly right. And also, inflation, I mean, not to try and get too kind of technical, but inflation is a measure of change. So it's not, when people say I see the CPI might only be at 2.7% up now, but my food prices haven't come down. Well, that's true, because in order for food prices to come down, you would actually have to see inflation go minus. It would have to be a negative number. And that almost never happens. If food prices go up, they tend to stay at a level, and then they might not go up much faster in the next few months or next year or two. And so there are certain parts of our spending that can be quite stable and quite static sometimes, but the one that's incredibly volatile would then be the price of fuel, because there are two things that impact the price of fuel. One is the exchange rate, because unfortunately we pay for our fuel as a country. We buy fuel and we pay in dollars for that. So when the rand goes from 18 to the dollar to 20 to the dollar, that means that our fuel has gone a lot more expensive. And then the second thing is that fuel itself is a volatile price, and it is priced in dollars, and it can go from $50 to $70 in a very short space of time. And then, you add that to the exchange rate, and fuel can be a very volatile thing. So there is a chance that we could see fuel prices come down, and that helps a lot with getting inflation to slow down. But unfortunately, things like rent or cost of housing and as I mentioned around food, those tend to flatten out sometimes, but I wish they would, but we don't see them going down unless you own certain properties in certain cities in South Africa.
Yeah, look, whenever food prices go up, I know it's unlikely they'll ever go down. You'll probably get a sale here and there, but even that is not enough. So if I'm getting your explanation correctly, it's quite possible for your personal inflation rate to be higher than the national average then, depending on what you're affected by.
Yeah, and depending on your income level, and your standard of living, if you used a great example, if you're growing your own food, and potentially you don't spend much on travel, then there is a possibility that you operate below the national average. But if you buy a high degree of imported items, you spend a lot of money on food that comes in packets, and lots of takeaways and those kinds of things, and then you tend to travel, either by public transport or on your own, and you do long distances every day, then the likelihood is that your cost of living might be a lot higher than the national average, and it is an important thing. I mean, it might just sound like a school lesson now to say, your personal inflation is different to everyone else's, and that's not the end of the story. Your personal inflation rate really matters to your long-term financial planning. It is something we really should pay attention to.
Then what kind of metric should we be using to measure our own personal inflation rate, and how important is it to know those numbers, maybe on a quarter-on-quarter basis?
I feel like we probably don't need to do it every single month. I mean, I know there are some people out there that love spreadsheets and love tracking things, to the last cent. And if you really want to, and it excites you to do it, then by all means track your expenses, every month and see how it changes from month to month. But I think, most of us, we probably want to have a fairly good idea of what it looks like. But I think tracking it once a year makes sense. And if it was me, I like to choose the same 3-month period every year. So let's just say, for example, you go February, March, April, and you look at what your costs were over those 3 months, and just divide by 3 so that you get a normal monthly amount, and then you do it again next year. And you choose the same 3 months, February, March, April, and you look at what your average for those 3 months was. And if you compare that average to last year's average, and you start to track it, it starts to give you a very good idea of what your typical cost of living is doing and how it's accelerating. Whatever the national stats are, that's fine. But for you, it becomes relevant to say, if my cost of living is accelerating at 11% a year, for example, and that now, you need to make some serious decisions around that, because, I mean, just to understand, the stock market probably grows at about 12% or 13% a year. So if your cost of living is accelerating almost at the same rate as the stock market is growing, it means you're going to need to invest very carefully and maybe take some serious decisions to control your cost of living acceleration, because you don't want to get to the situation where your cost of living is rising faster than your investments are growing, because then even if you're saving, you're actually losing the value of your money in buying power. So if your buying power is decreasing every single year, and your investments are actually going backwards, you could be in a position where you're really struggling financially in 5 or 10 or 20 years' time, and you feel like you've done nothing wrong. You've been saving every month.
And having a good handle on these numbers is very important. I'm actually looking at a table provided by Stats SA, looking at the compounded annual growth rate of different products that we eat and consume every day. So in 1986, the price of all gold tomato sauce was R1.39. Present day is around 46 Rand. So that compounding effect really hitting those prices. And if you are someone that lived in 1986, you probably wish you were in the period to afford some of these things. I mean, if you look at salad dressing, then was R1.59, Kleenex tissues, R1.45. These days, for one is R22.99, and even higher in some retailers as well. So it's good to prepare for your finances for times when some of these products go up.
And unfortunately, you and I won't get a message on our phone to say, hey, your cost of living has just gone up a lot because you eat tomato sauce and it's jumped up in price by 30%. You won't know that unless you're tracking it. No one's going to tell you. And so and it is a slow poison if you look at the way the cost of living changes, because we might not really pay attention to something like tissues. We just buy them because we need them. You can't just kind of not use a tissue if that's what you're using, and so you'll just buy it. But if it's going up by 15 or 20% a year, I mean, just to understand, if tissues go up by 15% a year, the price is doubling in every 5-year period. And that's really high growth. I mean, that's compounding against you. So it is really important to know that stuff. And you're right, when you look back over a 30-year period or 40-year period, that you start to see how much inflation actually destroys your buying power. And understanding that and being able to take action early on will really help you to make better decisions, number one. But number two, be better prepared for that change of cost of living as you get older and your investments become more and more important.
In conversation with Warren Ingram, the co-founder of Galileo Capital, in our personal finance feature, are telling us how we should be tracking our personal inflation rate and how that will then feed into our investment decisions in order to make sure that we can afford the standard of living. More after this.
The Money Show.
Personal Finance with Warren Ingram.
In conversation with Warren Ingram about tracking your personal inflation rate and how that can help you make sure you afford the standard of living to continue affording goods and services, Warren. While other costs increase, your wealth needs to grow at least at inflation or even better. So how can we make sure, as we track our personal inflation rate, we make sure that through our earnings, through our investments, we always have our head above water?
I think once you understand what your cost of living is doing and how it's growing, it allows you to make some clever calls around how your investments are structured. And the most important thing there is what's the mix of cash, government bonds, property companies, and then most especially shares in the stock market. What is that mix that you need to have so that you can at least track your cost of living change, or hopefully make sure that your investments grow faster than your cost of living? And the thing to understand there is that the stock market has a history of growing the fastest. So it'll track inflation and grow at about 5% a year faster than the national inflation rate. So if we're saying that inflation runs at 6% a year, which is not a bad average for the last decade or two, then you would say, well, the stock market's giving me around that sort of 12% number. And that's really the rocket fuel that allows portfolio to grow. So even if you don't like the volatility and the roller coaster ride of the stock market, if your cost of living is growing at, let's say, 9% a year, you can't really afford to have too much cash in your portfolio and too many government bonds, because cash, unfortunately, only grows at about 1% a year above inflation. And I'm obviously talking about cash in a fixed deposit or in a money market account. Cash under your bed, unfortunately, doesn't grow at all. And so cash in government bonds may be around 1 or 2% above inflation, and if your cost of living is growing at 3% a year above, or let's say your cost of living is growing at 9%, you're unfortunately going backwards if you only have cash and government bonds. So it allows you to understand what kind of risk you have to take, how much exposure you have to have in the stock market, and then you can reduce your exposure to the market if your cost of living is growing quite slowly. Alternatively, if you want to build wealth and you want to get to the capital accumulation phase, then understanding that the stock market is your engine of growth, then you're going to try and maximize that and limit your safe assets, which unfortunately don't give you the growth that you need. And I think that's the key decision, why this is so important. That's the thing you really want to understand.
We have a very good question here from one of our listeners, Simon, who's asking, if I have overseas investments, do I need a will overseas? So if I have investments perhaps maybe in Ireland or the UK, do I have to have a will that speaks to their region's regulations around these things?
It is a fantastic question. I agree with you, because the answer, unfortunately, is never simple. So it's not yes or no. It's yes, no, and maybe all at once. There are some countries, so for example, Ireland is one and Switzerland is another, that will recognize a South African will. So if you're a South African citizen, you've got money invested overseas, and you die in South Africa and you've got a will here, then part of your will appoint an executor of your estate. And what will happen then is that the executor will send a copy of your death certificate and that executor's appointment letter to the product providers that you've got overseas where your money's housed, and they will then act on the instructions of your executor as if they were a South African business, because they recognize that. But there are other countries that don't recognize South African executors and a South African will at all, and then if you don't have a will in that country and you die with assets there, it would be the same as if you die without a will at all, and that becomes an almighty mess. So I think it's a very important question to ask, and also one you should check before you invest your money there. The other thing around this is that some countries also charge inheritance taxes or estate duty to non-residents. So, for example, if you've got a bank account in the UK, and a lot of South Africans have a bank account in the UK, they think that that's a great place to store overseas money. Just understand that there is a certain amount of money where, if you've got, and I think it's £325,000 or more, you're going to pay estate duty or death duty on that if you die. Well, you won't, your estate will, and it could be as high as 40%. So then you need to make sure that you're doing some very clever planning, or move your money out of the UK into a region, as we mentioned, like Ireland or Switzerland, where they don't charge those taxes and they do recognize your South African will and letter of executorship.
That was Warren Ingram, of course, dropping gems every Tuesday in our personal finance feature. He's the co-founder of Galileo Capital.